All right, everyone. Thank you for staying till this late for the last panel of the day. Today we'll be covering the topic on choosing the right blockchain infrastructure for institutional asset tokenization. So before we begin, I'd like for the panelists to give a brief introduction on themselves, as well as what their organization is doing. Let's start from Alice.
Sure. Hello, everyone. My name is Alice King. I'm the PD Director at the HBAR Foundation. HBAR Foundation is empowering Hedera Layer 1 by providing fintech, financial business marketing support to the builders and institutions. I look forward to our panel discussion. Thank you for joining us.
Hi, everyone. Good afternoon. My name is Shawn. I'm from Interop Labs. So Interop Labs is the software development arm of Axelar Network. Axelar Network is one of the leading blockchain interoperability protocols that is widely used by both DeFi native applications and also some of the largest institutions like of JP Morgan and Deutsche Bank, where we have worked on some of the institutional tokenization use cases. My role is I head up Asia Pacific and also lead the go-to-market for institutional tokenization.
Yeah, hi everyone. My name is Sunny. I am the CTO and co-founder at Headquarters, HQ.xyz. We build treasury management solutions that help you run your business on-chain seamlessly. Thank you.
Hi everyone, my name is Chee, associate partner of EY. So I'm in the EY blockchain assurance team. So in assurance, we do like the normal financial statement audit, assurance kind of work, as well as MAS or regulatory attestation work that requires external auditor. But I'm not an auditor by training. I'm a technical guy, so I'm a technology specialist. But I support all the assurance work within EY.
Okay, perfect. Yeah. Maybe just a bit about myself as well. So I'm the head of ecosystem at D3 Labs. What we're doing is we're working with the regulators to provide a regulatory approved tokenization platform out of Indonesia. So yeah, I think let's begin. I guess to start things off, I'd like to ask everyone here, in one sentence, what would you define as the right blockchain infrastructure for institutional grade tokenization? Anyone wants to? Maybe you can go down. Keong?
Okay, I don't think there is a so-called right blockchain architecture or infrastructure because, I mean, you got to tick all the boxes, right? Like you got to have security, you got to have privacy, you got to have compliance, you have to have low cost, efficiency and all that. So I think it's hard to find one single infrastructure that can meet all requirements. Yeah, but what you can do is probably come up with something more hybrid, or it depends on which jurisdiction you work in, and then you design accordingly, whatever that meets your needs. Yeah.
Yeah, I think from our end, whenever we talk to clients, I think regulation is a big piece of the puzzle. They care less about TPS or decentralization in its essence. I think they are more worried about, do my bank accounts get frozen if I move from crypto to fiat? Are the regulators going to chase me? How do I file my taxes? Very pragmatic problems that they want to solve for, and I think that's what they look for in like their infrastructure.
So for us, because Axelar is the layer below all the L1 and L2s that potentially people are building on top, or even we have worked with projects like I mentioned earlier, JP Morgan and Deutsche Bank, where they're building some permission structures or even private networks. We are enabling those connectivity between public and private networks. So from our perspective is, we give you the flexibility to choose any tech stack that you guys want to build on. So we enable the interoperability between different blockchains so that, you as a firm, you are future-proof your tech stack to enable to build across other tech stacks as new tech stacks kind of emerge, new features on top of that.
Sure. As a layer 1, we think the right blockchain should be fast, secure, and also built for compliance. Institutions need infrastructure that support secure and scalable tokenization. On Hedera, we are the fast and secure network, and we have a lot of enterprise use cases already built on top of us. So it's actually proven by enterprise that Hedera is actually right blockchain to build for.
Okay, great. Yeah, I think the panelists have brought up a lot of good points on security, scalability, compliance. So I think right now, the current state of things is that, we're living in an increasingly, there's a lot of L1s, L2s, private chains and all that. So just like to ask Alice, how does Hedera's hash graph consensus model, does it differ from traditional blockchains? And how does it meet enterprise level requirements in terms of security and scalability?
Yeah, so Hedera is not built on traditional blockchain. It is actually built for a new distributed ledger technology called Hashgraph. It was invented by one of our co-founder, Dr. Liebenberg. It's basically a combination of gossip protocol and virtual voting algorithm. So from the ground up, we built this public layer in mind of compliance and scalability. So it's very fast, 10,000 transactions per second. It's very secure. It'll achieve like golden standard of security in the DLT technology called ABFT, asynchronous Byzantine fault tolerant, and also it's fair. We don't have fund running or MEV, so it's very the transaction is processed by first come first serve type of mechanism, and we have a native token services, and the services we support offer to builders to build on Hedera. It is actually built-in. There is a built-in compliance features like KYC, AML flag, also account level control and auditable log. So it is very safe and compliant area for institutions and enterprise to build on.
Okay, thank you. Yeah, I think we're seeing a lot more, different L1s and L2s, so a lot of fragmentation. I think is one of the issues commonly brought up. So maybe I'd like to ask Shawn, you're from Axelar. How does your interoperability solutions address the nature of this fragmentation? And, what can we expect from like a multi-chain future?
Sure. I think we have multiple solutions and products within the Axelar tech stack that enables kind of unifying liquidity on that front, right? So, so if you think of any interoperability protocol like Axelar, one of the core tenets of our product tech stack is message passing. So you can think of it simply as today, how banks kind of interact with each other through Swift messaging. That happens on the blockchain level too. So we are enabling to compose any app builders to send any type of logic from one chain to the other. So you do not actually need to utilize liquidity bridging, but you can potentially have atomic settlement across two different blockchains, just passing a message itself. Another product that we have is what we call as interchain token service, right? So essentially it's enabling any token or asset issuer to actually create a fungible token across multiple chains without building their own bridges. So you can enable either lock and mint structures or mint and burn structures. Essentially, you will have zero slippage whenever you move the asset across multiple chains. So you can hold your liquidity on, say, one or two chains, then route your liquidity onto those probably faster finality chains, then have a last leg to probably a slower chain, for example.
Okay, thank you. The next question I'd like to ask Sunny. You work with a lot of institutional clients, so what are they asking for in terms of like infrastructure? Are they leaning towards public chains, private chains, anything specific?
Yeah, I think in most cases it's public chains, but they do request more privacy constructs, I guess, to enable some of these transactions to remain private in terms of quantum. We can't privatize the wallets they're transacting. But absolutely, we can work on like making sure that the quantum that's being transferred can remain private. So public chains, but like private transactions in that sense, right? Or permissionless rather. So that's number one. Number two, I think the broader question that we tend to hear from clients is just around like where are the regulators how the regulators approaching so the use of some of these chains, right? Like for example, there are certain chains that are more contentious when you use them, and then other chains that are more reliable that you think from a regulatory perspective you may not get as much scrutiny, and then those are the chains that the clients will come and talk to us about that they want to build support. And then finally, I think it's just liquidity, right? Where is liquidity available, and therefore then they naturally will veer towards those chains as they work with us.
Okay, thank you. Next, I have a question for Keong. So, from a consulting and implementation perspective, what are some of the frequent infrastructure-related challenges faced by your institutional clients?
Yeah, in terms of infrastructure challenges, I think all of you should know, like, there's a blockchain trilemma, right? There's trilemma means that the three things: security, scalability, and decentralization. So previously, you can only achieve 2 out of the 3. There's no way you can achieve all 3, right? Of course, with recent technology improvement, yeah, it is possible to have all 3, the best of everything. But I think now the new world, if you refer to Paul Brody, which is our global EY blockchain leader, he will say that the new trilemma is not this 3. The new trilemma is product, services, and regulatory approval. So you can have, on one end, you have the DeFi, those who choose not to get regulated. So the good products, a lot of customers, but they are not regulated. So they cannot meet the trilemma, right? All 3. And on the other hand, you go to the banks, the traditional FI, they have customers, they are regulated, but they don't have much blockchain products to offer. They're still starting on the journey. And somewhere in the middle, there is those who try to get regulated, try to be compliant, and they have products, of course, like tokenization, RWA tokenization, but they struggle to find buyers or customers. So this is the new trilemma that we have now. So that's one of the challenges. Of course, the other challenge is, like what was mentioned, like interoperability between different blockchains. Not only that, interoperability between existing financial system, like the core banking system that was mentioned earlier in the earlier session, with your Web3 and DeFi systems. That's also another challenge. Yeah.
Yeah, thank you for mentioning those challenges. So I guess to all the panelists, what would be say, if you had to choose, the top 3 criteria that institutions would factor in when it comes to picking a blockchain infrastructure? What would you say are the top 3 most important things?
I think for top 3, I would say regulatory compliance in terms of ability to comply with existing AML, KYC, privacy, conditions across different jurisdictions, because each jurisdiction has different rules. Yeah, that is the complexity. But you have to comply if you want to play the game. Then the other one would be the auditability, the internal controls that you can provide, the risk management and governance that you have within the company to prove to your customers, to your investors that you are doing the right thing, you have proper controls in place. Yeah.
Yeah, I concur, right? Like, alongside that, like just to add on the last point, right, the auditability, there is a frame around it which is like reconciliation, right, where if we work with chains all the time, one of the biggest issues that we have is just indexing them and trying to figure out what these transactions are about, and naturally clients also struggle. Right, so if there's a chain that does not have any indexing solutions available or explorers, then clients tend to not want to go there. And therefore then, we also prioritize the ability at HQ to pick chains and advise clients to use chains, that already have an ecosystem of like indexes, not just one, and explorers that they can then verify the transactions against. And then that's where then we see that growth happening.
Yeah, so from my perspective is that, actually I have a slightly different view from the panelists here, is that if you look at how some of the blockchains are set up, and I would say most of the blockchains are set up, they would have a foundation that is probably thinking of from a decentralized governance point of view, versus like the developer teams, right, which I'm sitting on, take for example, Interop Labs. So we are like a service provider to the decentralized protocol. So I think the argument that we have been engaging, regulators and also educating a lot of the institutions is that how you can split out the components where applications at the gateway level, meaning you can think of it as the front-facing gateways to clients, and where there's risk involved, right, that's where regulation should be happening. And versus at the L1 level, you can think of it as the public internet as of today. Who is regulating the public internet, right? No one is truly regulating the public internet. That's operating across multiple intranets, across multiple cloud providers, and so forth, right? So from that perspective, if you are able to look at some of the merits of having a decentralized network, that network level should not have specific regulations that slapped onto like a Solana or Ethereum, right? It's a global state, it's a global ledger that have no regulatory, liabilities to regulators itself. But if you are an application builder that's building on Ethereum itself, you should build guardrails. And then the Ethereum tech stack or the Solana tech stack then need to have features that fulfill that regulatory requirements as an application builder. So for example, just now you talk about private transactions. Solana just recently, allowed this private balances, right? So and so forth. You've seen new, the likes of Hedera, they have different features that actually, which Alice can highlight more later. They have those features to actually enable application builders or institutions that want to build applications on top of that layer to actually fulfill their regulatory requirements. But as a layer 1 or as a permissionless protocol, it shouldn't be liable from that perspective like an internet as of today.
Yeah, I agree with all the panelists, but I would like to highlight one key area that institutions and looking at is governance. I think T3 Labs and Jordan will agree with me. They want to know, enterprises and institutions needs transparent oversight. So they want to know who's the node validator, who's operating the network, and who's making those big decisions for network operation. So on Hedera, we addressed this concern by providing governing council. We are inviting 39 global enterprises like IBM, Google, LG Electronics to run the node on Hedera and make the big decisions. And so far, when we pitch our approach to the fintech financial institutions, they're very acceptable and actually welcoming this different governance model.
Yeah. Thank you guys for all your chiming in. I think a lot of great points were brought up. So I'd like to ask as well, how have the regulatory frameworks influenced the infrastructure selection? And in terms of the regulatory frameworks, do you think any particular jurisdictions are currently like ahead of anyone else, more progressive in terms of being pro-tokenization? Maybe we can start with Alice.
Sure. So I work with a lot of enterprises and institutions. I remember my first conversation with the bank in Korea for stablecoin use cases. The working level and Web3 team, digital asset team was super welcoming this stablecoin idea, but it got stopped because in the legal compliance team. They think there's no regulation. If you want to do the stablecoin, you can do private network, not on public. And then fast forward, nowadays, Korea recently announced that they're going to make a regulatory guideline for stablecoin. 2 days later, banks made an assertion to issue a Korean won-backed stablecoin. So I think the regulation is definitely open up institutions to be more, endorse the new technology and be more innovative in their area. And I think in that regards, Singapore, I think Singapore is doing a great job. There's a lot of institution level pilots and guidelines that the other countries are looking at. So I would like to say jurisdiction like Singapore is leading the way.
Yeah, I think from my perspective, working across my firm, a lot of guys are in the US. We also deal with, I do face off some of the European regulators because we were working with Deutsche Bank. Then Asia, we are very active with regards to speaking to a lot of more of the sandboxes there. I don't think there is one clear leader right now, to be honest. I think different jurisdictions, different regulators are driven by different factors. Definitely what we are seeing on the headline side, the US is pressing along on the stablecoin side. With regards to moving asset tokenization, that is probably down the road. Then if you look at Asia's standpoint, there are very established sandboxes like in Singapore and Hong Kong. Definitely, just now you heard from D3 Labs, OJK is looking at it. Even in Thailand, they are looking at some, a limited sandbox within Phuket itself, utilizing stablecoins, so on and so forth. I think Korea, on the note of stablecoin, then Japan also have a stablecoin framework on that front. So from my perspective, right now it is about unifying a lot of the standards. So if you look at the work that is being done on a more global stage, I would say that the effort that's being done through MAS, FINMA from Switzerland, FCA in UK, and JFSA in Japan, I think they're bringing quite a number of the tier one financial hubs together on a roundtable basis, but it takes time. It's going to take time, right? So I've been following this space through the .0 forum. If you know that forum that's coming out in 2 weeks' time, every part of the year they have different forums that follows up a conversation through a roundtable basis where they engage both private and public sector in terms of giving suggestions. But, you know, it takes time before we hit some level of commercialized level of adoption.
Yeah, I think the way I see it is you split it into two parts, right? Like there are some jurisdictions that foster innovation and some jurisdictions that foster stability. For innovation, I would think like the States is probably far ahead than the rest of the world, and then for stability, you know, that I think someone said on the panel earlier, you know, that the slowness is by design, and you want it to be stable. You do not want policy changing consistently because then there are a lot of knock-on effects, right? And I think from that front, Singapore has been doing a good job. But that's not to say that like in Singapore, the governance or the bodies that are regulating, they are not aware or neither do they understand the nuances of crypto. I think some of the best DeFi people in Singapore are probably sitting in that team where they understand some of these very delicate nuances around like building some of these protocols, empowering some of them. So for me, I'm always surprised by like how much they understand, and it's a good thing from my perspective.
In terms of regulation and jurisdiction-wise, I mean, after the Trump election in US, you can see that definitely is pro-crypto, pro-DeFi. So I think things will be moving much faster in US. Then that's more on the regular aspect. But in terms of infrastructure, I would say that Singapore is actually quite advanced. So in terms of, especially for regulated financial institution, they recently have a global layer 1, right, under the Project Guardian. So that is like a single blockchain infrastructure for all financial institutions to connect. It's a shared ledger based on the blockchain technology. So they are taking far ahead, because if everybody start building their own chains, right, then interoperability become an issue, liquidity become an issue. So I think the regulator MAS, they had the foresight to say, okay, let's do a single infrastructure. But again, we shall see whether does it really take off. Yeah, right. So because Singapore being a small player, you know, if you can't get the other big players like the US, the Europe to take up this global infrastructure, then yeah, we will end up with the same problem. Then within the firm, within EY itself, I mean, if you were to ask in terms of what kind of infrastructure, we are always pro Ethereum or EVM compatible. Yeah, so our products are all EVM based. But in terms of course, audit, as an auditor, we audit any blockchain, yeah. But if we are to build products, we are always pro Ethereum, right? Whether it's layer 1, layer 2, yeah. So in fact, we come up, in terms of products, we actually have our own products like Night 4, which is an open source that you can go to GitHub and just install and download yourself, which is a zero knowledge proof with a zero knowledge roll up. So what this is, means the zero knowledge roll up is for layer 2, the scalability. The zero knowledge proof is for B2B transactions, privacy. So nowadays, all the SMEs, business to business transaction can be done on the public blockchain with full privacy. Yeah.
Okay, thank you for the insights. Yeah, so next I'd like to touch on a bit of the more technical aspects of things in regards to infrastructure. So Chee, I know you mentioned that you guys prefer EVM, but I think so in your time with Ernst & Young, what emerging infrastructure models are you seeing, that's gaining more traction in terms of like the enterprise POCs and pilots?
So, I mean, if you talk to the banks or the FIs, right, they all used to do POC in private chain, right? They were building private chains. So like I said, but with the US election, now with the new president, so things are moving to the public chain, right? We can see the wave that people are now willing to do things on the public chain, because previously of the regulatory concern, right, they did not dare to do it on the public chain, but now things are moving to public chain. And but like I say, some banks or FIs are slow to move, right? So they may want to choose a hybrid model. They may want to have some part of it still private, the rest public, somewhere in between. Or if they want to do it on a public, they might do it on a permission public, right? Where they do a whitelisting, KYC, etc. on a public chain. So that's what I see going forward.
I see, yeah.
So I can actually share more on that infrastructure, right? So the infrastructure that we are building with Deutsche Bank is what Chee was mentioning, a hybrid structure. It's built on top of public Ethereum. So all proofs are all going back to Ethereum itself, but the stack is using a ZK-based stack. Then the validators are all whitelisted validators. So essentially, Deutsche Bank can, or say for example, Deutsche Bank can whitelist specific validators that they trust. Then on top of that, every participant needs to be KYC'd, meaning all the institutions B2B basis needs to be KYC'd to participate and deploy our application there. Then we have the infrastructure also proposes and designed to a way where we can actually isolate certain roles and functionalities. Take, for example, viewing of transactions, where even though it's on a public level, you only see the proofs because then it's only the state change. Well, just going too technical on this run, right? But the actual transactions between within the ZK chain itself, you are not able to see who is who unless it's your transaction, right? So from a blockchain explorer that Sunny mentioned earlier, the blockchain explorer have a rights basis, meaning for someone who signed in, say for example Deutsche Bank, they only can see Deutsche Bank's transactions, right? And their counterparty, right? But the institutions that is not participating in transaction cannot see that. Then regulators have a read-only oversight that then you can do this auditability, regulatory oversight on top of this hybrid model.
Okay, thank you for sharing. I actually like to ask Sunny as well, because you work with a lot of Web3 native businesses. So what does a preferred infrastructure model look like to you, or at least some of your Web3 partners?
So generally we work with CFOs and finance teams. In most cases, they tend to veer towards very plug and play type of infrastructure. So wallets that I can easily load up, or stablecoins that I can easily get access to, whether it's on a centralized exchange or whether I have a OTC partner that I can work with quickly to get things up and running. I think depending on the use case that we serve tend to be very operational in nature. In that use case, the lean is always towards ease of use, regulatory acceptance, and FI acceptance. So at the end of the day, the client will not get upset if the transaction gas fees, for example, is a bit higher. Not as upset as, oh, my transaction to my employee for payroll got stopped by the bank, right? So in operational use cases, we tend to see teams picking chains or infrastructure in general, products that are plug and play, number one. Number two, they've got regulatory acceptance. And then number three, in most cases, FI acceptance.
Okay, thank you, yeah. In such a situation, do you think that, as there would be more of roll-ups and app chains becoming more dominant in this, would we risk creating more silos? Maybe I'd like to hear from Shawn as well.
Yeah, I think right now for institutions, it's always a dilemma for them, right? Because most institutions are centralized. They do not want to use a JP Morgan stack, for example, right? JP Morgan have their own private blockchain stack called Kinaxis. Imagine you are now Goldman Sachs. They will say, why must I pay fees to use your DLT stack? So there is no neutrality in that sense. So it becomes interoperability has become a huge thing for them. But I feel like if, let's say, we move into a more public, permissionless way of deployment, then you have a more neutral layer that you're building now, right? So it really depends on how regulations actually evolve. If you're asking me purely on an institutional deployment side, right? Because then you will see the way we kind of advise them on the design architecture will differ based on regulatory advancements. But if I were to kind of superimpose that to how the Web3 space is evolving, you are seeing more app chains popping up because everyone wants to control the tech stack, everyone wants to control the economics of things. But the thing is that right now we haven't seen the right amount of users that's onboarding to actually justify everyone running their own chain. Because if you look at what Vitalik is saying is that everything cannot just run on Ethereum mainnet. There is a scalability problem from that perspective. He himself kind of acknowledged that. That's why this roll-up centric roadmap came out, but now he realized that there is other ways to scale it, right? So I think best to read it. I will not be the best person. I'm not Vitalik on that front.
Okay, thank you. Yeah, on that point, right, I actually like to ask Alice, because at HBAR Foundation, Shawn mentioned the problem of certain enterprises may not want to sort of like be building on someone else's chain, and then for you guys at Hedera, that there are a lot of enterprises running the nodes for you guys. So have you guys actually considered like maybe creating roll-ups or modular components to prevent the situation that Shawn mentioned?
Hedera, we do not need roll-ups as far as I'm concerned, because as I told you, it's not a blockchain, it's a hash graph consensus algorithm. It's super scalable. I mean, Hedera has processed more than 72 billion transactions since 2019 from real-world use cases like Hyundai Motors. They are using Hedera for a carbon emission tracking platform. Tons of transactions happening over there. Our network never had a congestion from that. So I think the scalability is not an issue for us, but we understand the interoperability can be a challenge. So we start supporting EVM in a smart contract also, and also we work with the Axelar and Layer 0 for the interoperability so that the enterprises, if they have a preference on their public chain, they can still talk to us. So that is another angle, and we actually building more toolkits so enterprise can easily adopt Hedera. Toolkits like Stablecoin Studio, Tokenization Studio, and Guardian ESG framework that is kind of remove all the burdens that enterprise in terms of development and enter into Web3.
Okay, thank you. Yeah, so I think we're running out of time, so I'll move on to the last question. So I'd like to ask all the panelists, what's one myth or misconception about institutional blockchain adoption that you would like to debunk? And where do you, in one sentence, where do you see the institutional adoption of blockchain heading towards in the next 1 to 2 years? Start from Alice.
I will start. The myth. The common myth is that institutions, they think about adopting blockchain if there's a client needs or if they want to get a slice of Web3 TVL. It's more like external stuff, but actually the real value is coming from internal processes. So I think the myth is that they're looking at only external business opportunity. They're not thinking about how to improve and adopt blockchain for their, improving their internal processes, like making easy, simplify compliance, and also streamline their internal communication. So I think they should look at blockchain is not only for external, internal. That's the myth, and the future trend. I think tokenization is definitely just start, and we see a lot of adoption here. Now the institutions are looking at not only tokenization, but how those tokenized assets can be distributed and also transferred to other jurisdictions. So I think DID with the tokenization will be a key, and I think infrastructure like us should also think about how we are going to support those needs going forward.
So one myth is that, institutions know no shit about blockchain. It's not true. I think right now, institutions have already built up quite a bit of talent and also understanding from a lot of strong BD teams across all the Web3 space. Definitely from that perspective, they have kind of increased in terms of knowledge. But the biggest blocker for them is not technology. Technology is not the blocker. The blocker here is like what Alice is mentioning, a lot of internal bureaucracy, a lot of risk compliance requirements that they have yet to work around. Definitely regulations at the highest level, it's a blocker, but tech is never a problem. Like they can switch text easily, but it's not a problem on that side. And with regards to one sentence, I would say, echoing earlier panelists and speakers, I would say in the next 3 to 5 years, you will see a lot of things happening on public blockchains.
I think from my end, I would say institutions or businesses rather, they don't really care about TPS that much after a certain amount. And I feel a lot of the conversations between chains and the maximalists in the space, they harp on those fronts quite a bit. What they really care about is like I said, right? Regulations, are they in place for me to run my business carefully? Are the banks actually supporting my workflows, my use cases for payroll, for example? So they care about that more. Innovation that I think will move it forward. What I see is probably more different stables appearing, not just US dollar backed stables. I think the world needs more of those so that we can actually have not interoperable, but like currencies that can actually work, entire workflows that can actually operate fully on chain. Right now we have scenarios where it goes from USDC to the yuan and then back to USDC in some scenarios where it doesn't make sense to us. We would prefer to see it more like stablecoin to stablecoin exchange happening. And then you suddenly come into an environment where it's highly efficient when you're trying to move money and capital.
So for like banks and all that, I think one of the myths that I see is them thinking that, okay, if it's a public decentralized blockchain, it's something that they cannot control and therefore it's something that they don't trust. I think that is a factor that's affecting them, but slowly I think they are changing their attitudes, right? But then that comes to the next question. So if I were to use a public blockchain, what happens if it's down? You know, what's my BCM, business continuity plan, right? So that's why earlier I said that we advocate for EVM or Ethereum, because if one EVM or one layer 2 down, you can always shift over. Your smart contract, everything is on Solidity. It's still backward compatible to another EVM chain. You can just migrate over as part of your BCM process, business continuity. Then in terms of going forward, what I hope to see in terms of the trend is that it's not just FIs or Web3 companies that's using blockchain. We should go down to the next level. So who are the banks serving? The banks are serving all the merchants, right? The suppliers, the supply chain. So this is the next level that we should tackle, or we should see more adoptions. So payments in terms of paying, like for example, like EY, we did a payment with SAP, Enterprise Resource Planning software, that you can now use stablecoin to pay through SAP, right? Things like this kind of use case, or use case in terms of traceability, right? Tracing your supply chain, from your merchants, your farm, to make sure your carbon credits and all that. That's what I would see in the future growing. Yeah.
Okay, yeah. Thank you everyone for sharing from your perspectives. I guess with that, let's wrap up the panel. Thank you all you listeners as well for staying, for the last session of the day. I guess that's a wrap.